All right, welcome everyone. Thanks for joining. I hope you're all having a wonderful week. As always, we have a lot to jump into in this episode. We'll be going over my portfolio, the Story Fund. We'll be looking at companies that I'm actively buying. These ones I think are all good value right now. I've been buying them this week and last week. And we're also going to be talking about valuations, the stretched valuations of the stock market, and in particular, the PE ratio, that metric of valuation. We're going to be discussing all of that in this video. But before we jump into it, there's one subject I want to touch on first, and that is I've been noticing on YouTube, there's a lot of financial commentators, a lot of financial YouTube channels, and most of them, I think, do the same thing. They give their opinion on stocks, they give analysis, they give their opinion on investments and investment philosophy, but for the most part, it's a lot of jibber jabber, and they never actually show you what they're doing with their money. They don't transparently show you what they're investing in. They don't transparently show you the results of their investment. They just make more content about popular topics or stocks. We do things differently here, very differently. I not only show you every single investment that I'm making, when I'm making them, and how much I'm putting into each company, but I show you the results of it. Not only when it goes up in value, not only when times are good, but I show you the results even when things go down in value, even if I'm underperforming, even if I make bad investments. I show you transparently every single investment that I make, good or bad, completely transparent. And I think that it's more meaningful to do this because I'm not just hypothetically talking about different companies. This is real money being put into these stocks. I'm not a multimillionaire. This is a significant portion of my money. Between this portfolio and the passive income account, that is the huge majority of my net worth. Of all the money outside of equity in my house, that is it. That is my investment. So when I do analysis on different companies and I'm bullish on them or I'm bearish on them, I'm not just being an armchair quarterback. I literally am putting my money where my mouth is. And I think that that's worth keeping in mind when you're listening to other people talk about different stocks. Many of them, they give their opinions so openly about different companies, and they never share whether or not they're invested in them. And if they do, they don't show you the results week by week, because that would open them to scrutiny and criticism. If I underperform the S&P 500, you better believe I'll get the hate comments and the criticism because I'm underperforming. So I just want to highlight that. That is a distinct difference between my channel and many others. There's a few others that do show performance to some extent, but I don't think anywhere as transparently. So if that's something that's meaningful to you, seeing real money, real investments, a real portfolio, and real transparency, showing the results every single week, good or bad, you'll find that in this channel. You can follow along for free. You can subscribe to the channel, and you will get real money and real investments with real transparency and results every single week. Now, on the other side of things, if your goal is to just watch content where people talk about stocks, they give their opinions, their analysis on stocks, but they never actually show you if they're buying them. And if they say they're buying them, they don't show you the amount or how much it makes up of their portfolio. And they definitely don't show their results on a consistent basis holistically. They'll sometimes highlight results of companies that have done well, and they somehow forget to mention ones that have done poorly. If you want to follow those type of channels, they are a dime a dozen. There are literally hundreds of other YouTube channels right now you can go to where people will give you their opinions on X, Y, and Z stock, why it's going to go up, why it's going to go down, but they never actually show you what they're investing in, what they're doing with their money. We do things differently here. I show the actual results with my actual money. Now, having said that, let's go ahead and look at the performance of the Story Fund. If we look at it compared against the S&P 500, this is the last update as of market close today. The Story Fund is in blue. The S&P 500 is in red. The Story Fund has returned 22.27%, and the broader market has returned 19.59%. So we're beating up like 2 or 3%, not a whole lot, but it does start to add up when you think that that's actually like $2,000 or $3,000. So it does make a difference over time, but right now we're not beating it by any significant amount. Now, before I go into the companies that I'm going to be buying and the reasons that I'm bullish on them, I first want to talk about valuations in general. We know that the stock market right now it's at a point where it has stretched valuations. And this is on the basis of PE ratios, price to earnings. Price to earnings is how much the market cap is per share over the earnings per share. That's how you get to the price to earnings. And it can be calculated based off the trailing 12-month earnings of the company or the forward 12 months, which is the analyst's expectations of how much a company is going to earn over the next 12 months. This is the most basic fundamental valuation metric. Out of every one that you can pick, price to sales, price to book, the price to earnings is the go-to fundamental valuation metric that almost every value investor and every investor in general looks at when they're making future investments. Now, the struggle for investors like you and me is we have a bit of a conundrum. We don't want money sitting on the sidelines in cash because we know that there's inflation and our money's slowly going to depreciate over time as inflation, I think, will run higher and higher, at least keep above 2%. We're going to steadily lose money with cash. But at the same time, we don't want to buy companies that are overpriced and potentially have some collapse in the future and lose a lot of value. And right now, the S&P 500 is trading at a 20.7 forward earnings basis. We're paying 20.7 times the next 12 months earnings. That's pretty expensive in historical context. You can look at the graph here. It's pretty pricey based on historical context. So we have a bit of a catch-22. We have the option of sitting in cash, slowly seeing our money depreciate, twiddling our thumbs, waiting for a crash, or we invest in overpriced assets. Those seem like the two options. But I think that there is a third option. I don't think we have to pick between overpriced assets and sitting in cash. And I think that in some cases, and this certainly doesn't apply to every company, so big disclaimer, this is not a generality. This does not apply to every company, but in some cases, I think the PE ratio for some companies is a liar. I think it is a lying statistic. I don't think it's a good indicator of the future performance, the returns, and even the future earnings potential of that company. Because the PE ratio is based on just the next 12 months. But many companies have a much longer timeline, a much longer point of view. And their earnings are able to grow rapidly because of projects they have on the back burners, projects they have that aren't earning money, but have huge earnings potential that haven't been realized yet. I'll give you a couple examples, and these are companies that I'm actively buying right now. One of them is Google. Right now, Google's forward PE ratio is about 28. It's 27.86. That is the consensus analyst estimates of their next 12 months income. Now, if we're just looking at PE ratios, we could conclude that Google is overpriced and it's not a good investment. And if we look at the S&P 500, this would seem like the better investment because it's trading at a 20.7 forward PE ratio. But the difference is Google is one of these few companies that pours money into research and development, and they own hundreds of different projects that all of them have huge potential, and some of them could be monetized, but they actively choose not to monetize these projects. They just grow them bigger and bigger so that the earnings potential down the road is even more massive. So these projects they don't show up in the next 12 months earnings. They're not projected out there, but they're things that are very valuable in the future. Waymo is an example. Waymo is way under monetized for Google, so it doesn't show up right now on their next 12 months earnings. And they have a ton of optionality. This company can monetize in 1,000 different ways. They're doing the same thing with YouTube. This was once a money-losing platform that they had to subsidize with their main business every single year. Now YouTube's going to be a cash cow. It's going to be passing Netflix. Not only are they monetizing through advertisement, but they also have memberships. Right under every channel, they're going to have memberships. They have live chats. They're taking over Twitch. They have other optionality baked into every product they have. So while the PE ratio is well above the market average, Google's probably an underpriced company compared to SPY. And even the Morningstar analysis, their discounted cash flow analysis, they conclude that the earnings potential of Google is much greater than what the PE ratio right now would show. They say that the fair value of Google is $3,200. It currently trades at $2,900. I think that this is a fair analysis of Google. I currently think the company's undervalued. I've been buying it for a long time now, and I'm still going to continue buying this one. I think that I'll be proven correct in the future. This company will outperform the S&P 500. Amazon is another example. This company right now has a 47.6 forward PE ratio, way over double the market. The market's again at 20 and Amazon's trading at a 47 PE ratio. Many people might look at that metric and they say, how could Amazon possibly be a good deal right now? The same problem exists with Amazon. When people look at doing analysis on this company and they just look at the earnings multiple, they don't factor in all the different things that Amazon is working on that they have not realized the earnings potential of yet, and they will not show up in the next 12 months. They are years down the road. Amazon is doing autonomous vehicles. They're huge into media. They're taking over sports media. They have Amazon Prime membership with 200 million subscribers. They have so many things going in the background with their logistics, their infrastructure being built out. Amazon currently has over 1 million employees working, driving vehicles, and in warehouses. Jobs that eventually will be automated. You better believe that Amazon is going to automate 70 to 80% of those jobs over the next 5 to 6 years. And if they do that, their margins will go up significantly. They won't have as much overhead. And if Amazon improves their margins ever so slightly, you better believe that this PE ratio will drop like a rock. It'll come falling from the sky like it has done throughout history. Amazon is one of these companies that the PE ratio has consistently misled investors into thinking it's more expensive than it actually has been. And we can look at example after example of this. This is the PE ratio of Amazon over time for the past 20 years. Over its history, it's been an expensive company based on the PE ratio. And one of the most notable things about this chart is right here, when the PE ratio was extremely high at 400 plus, that was in 2015. A share of Amazon during this time cost $350. $350. Right now, a share of Amazon is $3,475. It was heavily deceiving to investors. This looked like an incredibly expensive company, yet it was one of the cheapest companies in the market based off its future earnings potential. Now let's take a look at how deceiving this was. If I change the chart here to show the earnings per share of Amazon over time, you can see that for about 15 years, Amazon on paper earned no money. It was completely flat. In fact, sometimes it had negative earnings. Sometimes it had a little bit positive earnings and then it would go back negative per share. And investors for 15 years, despite knowing this was a great company, despite using their services and their customer service and being an Amazon Prime member, they looked at the price of it and said, it's not earning a lot per share. It's really not a great company because their earnings per share is very low. And they would stay out of this investment. Little did they know they're growing market share in every single industry. They have AWS, it's a powerhouse of earnings, but they reinvest all of that into other segments of business. All their business metrics are growing dramatically, but again, the valuation looked crazy because they were artificially suppressing their earnings by reinvesting into other business segments. Then in 2015, when they hit the critical mass of scale, all of a sudden their earnings explode. They go from earning negative 90 cents per share to earning $10, $20, $30, $40, $50, now $58. The earnings are climbing like a vertical line right now. They're going up so fast every single quarter. And I don't suspect this to slow down. With the amount of things that Amazon has going on right now, I expect the earnings to continue to rise like that. And I think that the PE ratio right now is still misleading with how cheap this company is. For instance, the CEO of Amazon just said this week that, quote, it's still early days for us in media. It's in the early days. They're just getting started with their transition of owning all of legacy media. And you can see that Amazon has been doing this. They own books with the entire publishing industry and distribution of books. They own the entire industry. They're taking over Barnes & Noble. They're taking over every other book publisher. They have the Kindle, so they have that as well. They also have podcasts. They're buying up those left and right, competing with Spotify. They have Amazon Music, so they're big into the music industry as well. They have TV shows and movies and comedy routines on Amazon Prime, and now they're going into sports as well. Amazon is in the early days of owning media, and the fruits of this, them owning this industry, will be seen down the road. It's not factored into the next 12 months earning right now. It's heavily suppressed because they're reinvesting so much into these businesses. So this is another case, another company where I do not believe that the PE ratio is the best metric to go off of. And that's why I'm buying Amazon right now. I think that the company is heavily undervalued despite having a high forward PE ratio. I agree with Morningstar. They also see the earnings potential of the company. They look at all the different businesses that aren't being monetized currently that will be monetized in the future. That's why they say the fair value is $4,200 a share when it's currently trading at $3,450. Now, one thing I want to reemphasize once again is that this is not a rule I would apply to every company. Google and Amazon are very unique companies in that they have so much money to pour into different business ventures and reinvestment opportunities. Most companies don't do that. They don't spend as much time reinvesting and looking to grow different businesses. So the PE ratio for most companies is far more accurate than a company like Amazon or Google. I think that Amazon and Google are two companies where the PE ratio is heavily misleading. most cases, I think it's a much better indicator. Now, that's my thoughts on valuation, on PE ratio. I'm currently buying Amazon and Google. I think that both of these companies will outperform SPY, but we'll see over the next 5 years. I hope you enjoyed the episode. I'll see you in the next one.